Hey, good afternoon or good morning if you're on the West Coast. Welcome to Q4. We've made it almost to the end of the year. The panelists were just talking about how many CPE credits they need. So welcome to the Q4 Market Trend Series, where we're going to try to have a little bit different spin today. We're going to show some data, but the real focus of today's webinar is to talk about how to use data to potentially reduce risk, and hopefully reducing risk makes everyone more profitable. With that as an intro, everyone will be on mute. You can unmute yourself during the Q&A session, but you can also submit any questions through the question function on your dashboard, and we will get to those in the order they came in. Housekeeping wise, webinar will be recorded, the presentation deck will be available, and that recording will be distributed a couple days after today. CPE is available. We're not sure if our panelists are going to get it, but hopefully they will. Some of our panelists need CPE credits, but you got to answer all 4 of those poll questions, and we'll email those CPE credits within a few weeks. And then there will be a quick survey at the end of the webinar. We really do appreciate your feedback. Like the person doing the introduction should have prepared better, and that would be a good comment to make. Well, let's talk real quick about Richie May. Almost 40 years in the industry, we focus on the mortgage banking industry, though we do participate in other segments, particularly with our cyber and Patrick's area, where we do a lot of technology audits, SOC audits, etc. But understanding the market in an unparalleled way. Obviously, it's been a challenging year in 2024. We really like to thank all our clients for the partnership. We know the last couple of years have been particularly challenging, and there's a new MBA forecast out today that shows if you really like mortgage rates at around 6.3%, you're really going to like their MBA forecast, because we're going to be here through 2027. But we do a full suite of services out there, advisory, tax, audit, but we really are deep into the mortgage banking industry. And with that, today's agenda, which we could just skip over. No, we're going to have Mignon, and I'm going to introduce each of my panelists here in a second, but I'll do a quick mortgage landscape. We're going to talk about data and operational controls. Tyler is always going to have some great benchmarking financial data from our various products here. And then we've got Pat, who's going to talk about IT controls, and then we'll have a Q&A session. So, you know me, Seth Sprague, Director of Mortgage Consulting. Richie May, been here 2.5 years, been in the industry 27 years, 30 years, I don't know, round up. We've got Tyler House, who is our Director of Analytics. He's got all the data. He, as I always joke with people, he has the wonderful privilege of being on the other side of that wall. So I drive him crazy. But so you should don't ask Tyler any tough questions, because he has to deal with me every day. And then we got Mignon Davis, who is smart enough to not be in Denver. She's in Arizona, so we can't bother her too much. But Mignon is a Director of Risk and Compliance here at Richie May. She does all our subservicing oversight. She does a lot of our internal audit work. So Mignon's a great resource for all of our compliance needs. And then we've got Patrick Nestor, and he's out in Ohio. So we can't bother him too much either, though Patrick does come to the office a couple times a year. And he is a director in our advisory group, and he's really going to talk about the IT. And before I sort of turn it over to the good panelists, I guess I'm going to talk real briefly about kind of the mortgage landscape and where we're at. Obviously, we've just had a presidential election, and we have the Fed moving rates. The short end of the curve is moving down, and the long end of the curve is moving up. We've got inflation concerns. The MBA just, as I said, revised their forecast. And so we are in this kind of, Tyler and I were talking earlier this morning, we really are kind of in this staging area where we're not really sure the absolute direction of where mortgage is going to go in terms of volume and profitability. And that's why we thought this webinar would be great for folks, because it's really going to talk about data services that we've got here at Richie May, data services within your own populations. And so the landscape is changing, and it's changing at a quicker pace. And so we thought this would be a very timely presentation for everyone to hear from our experts, our great experts on the call. And then there's me, who is really just a moderator here. So with that, the first poll question, I guess I'll answer this, and since I have it written down here, thanks to Gabby. But when you do you get your data from your servicer, and if so, do you know how to use it? And the answer A, I get it but don't use it. B, I get it and know how to use it effectively. Or C, I don't get any. And remember, To get those CPE credits, you have to answer all 4 of these poll questions. And there's really no right answers, though. Mignon may say a couple of these answers are more right than others, or at least one of them, before I turn the presentation over to her. But Gabby, our wonderful, keeps everybody, our referee here, keeps everybody in line here. Let us know when we're starting to get to critical mass so that we can make sure folks get their CPE credits, because it is approaching the end of the year, and I know CPE credits are critical for everybody. So again,
like 5 more seconds. Make sure you get your votes in if you're looking for that CPE credit.
and remember, you got to answer all 4 of them to get them. And then I don't know if I'll be able to see the results or not, but I think Mignon will, and Mignon, that may be a good introduction to your part of the presentation here. So Gabby, we good to turn it over to Mignon?
Looks like we still have some coming through.
All right, we'll give another minute. I'll tap dance for a little bit longer, but I'm not that really good a dancer here. But Mignon's going to come in and talk about data needs, how to leverage data that you may have. And it will be very helpful as we kind of approach the year and hopefully setting everyone up for success in 2025. So with that as an introduction, Mignon, I'm going to turn it over to you.
All right, thank you. And it looks like the results are in. We have about 27% of you said that you get data from your subservicer, but you don't use it. About 50% of you said, I get it and I know how to use it effectively, so that's good. And then about 23% of you said you don't get any data at all from your subservicer. So that's a great intro into what we're going to be talking about here today. And I want to really kick it off by saying that I am not one of those data junkie people. And if you're anything like me, you may feel overwhelmed and even inundated with all the data that's coming at us from every different direction, right? There's data overload sometimes, and you may not know what data is useful to you. And you may even spin your wheels on a bunch of data and looking at it and trying to dissect it, and it's not even that relative or useful to you, and it's really distracting you and taking up your time rather than helping you. So that's what we're really going to talk about today. And spend our time on and talking about the data that we get from our subservicers. So let's talk about data hierarchy, and some of the questions that you may need to ask yourself is, are you paying attention to the data that your subservicer is providing you? Going back to that, are you getting any, and what are you doing with it? What pieces or data subsets are important to you? What should we be looking at? What's the risk if we don't look at things that we should be looking at? What are the risks here involved with, not looking at our data or not knowing what to look at? So that's what we're really going to focus on today. So servicing data about your portfolio's performance is critical to help you identify risks and help drive decisions about your portfolio. So it's important to understand the data infrastructure that your subservicer has and what information and data points your subservicer is pulling in to all of this data that they're providing you. And overall, you want to pay attention to how much your subservicer is investing in data and data-related projects and how it's presented to you. And also pay special attention to how the subservicer is using the data internally too. You want to use it appropriately, but you also want them to be using it, to help their internal operations. And I spoke with a subservicer recently who said that half of their capital budget this year went to data related projects. And that's huge. That demonstrates their commitment to providing clients with the data and the tools that they need to drive decisions. And one main goal of all of this data and collecting all of this information is to create opportunity for clients, right? And we often hear clients say that the reports or the data that they get from their subservicer doesn't line up with the data that their subservicer is using internally. So they may see an anomaly or a pattern in the data that they're getting, and they call their subservicer and say, hey, I'm seeing all this, and the subservicer says, oh, well, we don't have that report. The report that I'm looking at says something totally different, right? They don't align, and that's an issue. So you want to make sure that the data that your subservicer is using internally is the same data that they're giving you that you're using internally, right? They should line up, and oftentimes they don't, which is really surprising, but it is happening out there. So make sure that it's the same data. And some of the key things to focus on that we'll talk about here: payment activity. We're going to talk about that in a little bit more detail in a few minutes, and how month-end timing can impact those numbers. Escrow is another one to focus on, and understanding when you're going to be short on escrows and how much, right? Pay attention to these numbers and knowing how to use that data to create financial projections. Delinquency is one that you want to focus on, and how are you going to handle the cash needs for servicing advances as those delinquency numbers increase, for example? How are you monitoring customer behavior and understanding how that could lead to delinquency? And you can run projections on all of these data points. And this data can really help you also monitor your subservicer's performance and validate the adequacy of their delinquency controls, and making sure that your subservicer is handling those delinquent loans appropriately. You also want to look at consumer complaint trends. Again, helping you monitor your subservicer's performance. What are customers complaining about with the subservicer, right? What could be going wrong? What's broken within the subservicer that we need to maybe address with the subservicer? And compliance metrics is another key element that a lot of the subservicers are really building models where they're able to test entire portfolio every day, test based on some controls that are embedded into their system. And they really have kind of a model where it's maybe a red light, yellow light, green light scenario where, something passes. It may not be just pass fail, but it's, when something's yellow, it's getting close to a deadline. Hey, let's pay attention to those things. Red means it's really failed. But if they're providing that information to you, you can really identify where things might be breaking down within the subservicer's operations, and can really give you a lot of good information on their performance. They a lot of times will have embedded in these compliance metrics internal SLAs that they're testing to. Could be regulatory things that they're testing, and they're typically testing the entire portfolio in these situations. Another thing that I wanted to add to is I wanted to talk about recapture. If you have a recapture agreement with your subservicer, you want to find out how your subservicer is marketing and soliciting those customers, and what kind of data points they're pulling in to be able to identify what customers they can reach out to and provide that marketing or soliciting material to. If you're doing your own marketing, your subservicer may be just providing you the data and you go do your marketing. But however you have it set up, if you do have that recapture agreement, make sure you're working with your subservicer to understand what data points they're pulling in to be able to identify loans that they may be able to help you increase your recapture rate. Things like payoff requests, escrow inquiries, interest rate, property valuations, those are all data points that can be used to be able to identify loans where you may be able to solicit those borrowers.
I mean, you got a lot of stuff here.
Yeah.
Like standpoint, when you're using a subservicer, who's responsible? Because recapture is sort of an origination function, compliance is a compliance function. Like, how many people, can you talk a little bit about some of the best practices at somebody who's using a subservicer? Like, who's involved in monitoring it? You got financial aspects, you got compliance aspects. Like, how is all that? Is there like one central person that's disseminating this information, or is it each logging in and doing their own thing? Like, what do you see across some of our clients with their best practices and trying to manage the data and the key data, so that I'm not getting compliance data and Tyler isn't getting recapture data if he doesn't need it?
That's a great question, and we see it set up in a variety of different ways. We have a lot of clients where, it's just one person, perhaps the CFO is the person managing that relationship with the subservicer. We see that a lot. And, so some of the compliance metrics and internal SLAs and regulatory things may not be something that they're delving into a lot. They may just be looking at more of the forecasts and the financial projections, which is still good, still definitely something that they need to look at. But we also see it in situations where we have clients that it's a compliance officer perhaps that's overseeing that relationship. And so they would be focusing again more on the compliance side, so kind of the opposite. So we see a variety of setups. Very rarely do we see large teams that would be diving into all of the different areas. A lot of times with our smaller clients, especially, it is more like one person or two people maybe. And so it probably is very difficult for them to dive into all of the different important data that they're getting from their subservicer.
So it sounds like one of the key takeaways from this slide and your information is that if you're getting the data, make sure that you're getting it to the right person who's going to prioritize it appropriately. For example, if Tyler is in charge of recapture, he's not going to prioritize compliance. He's going to be prioritizing recapture. The CFO may have a different lens. So again, if you're using a subservicer, maybe just understanding what you're getting and understanding how to like redistribute that is a critical element just to make sure you're using the data appropriately.
Yeah, absolutely. Absolutely. I think that's a great point. And it's really fascinating as I talk to the subservicers, there's so many different things that they're able to identify in these data points. I talked to a subservicer recently that said they're really trying to drill down what's the best way to communicate with customers because things are changing, right? We're not, snail mail doesn't work anymore. And sometimes emails don't work either. Or should we go to text messages? Do we send videos to clients? There's lots of different ways to communicate, and they're really trying to figure out, okay, what's the best method? What do people respond to? And they sent out an email campaign. It was about flood zones. Flood zones had changed, and there had been a disaster and a hurricane. And so they sent out all of these emails about the flood requirements there, and they were able to determine that 70% of the customers that they sent those emails to opened the email on that same day that it was sent. So little pieces of information like that are really, really helpful in knowing how to reach customers quickly and successfully, and is very impactful into the way the organization is going to work. Yeah.
No, that's great. That's great. That's a great takeaway for folks is to sort of maybe rethink for 2025 how they're going to ingest the data that's being provided. I know people send me all sorts of emails that I don't read, and I got like 7,000 unread emails. But, certain people get prioritized, like Gabby always, when she sends me an email, I respond to her.
Well, and I was going to ask you, Seth, in talking about data and how it helps clients understand their portfolio, when we see spikes in delinquencies, especially, with the timing of the month and the end of the month, the last day of the month, and how it falls within the calendar, what things should we consider?
Yeah. Well, if I were on a servicing portfolio and, it ended like November's going to end. Wait a minute, no, November's going to end. Yeah, it's on a weekend, right? So if a person's, if the calendar's ending on a weekend and somebody's delinquent and then they make a payment, that's somebody, in my opinion, that should be brought up to, maybe we should be reaching out to that customer and seeing what's going on there, right? They're just barely making that payment in. And, maybe there's something that could be done to help them out, or, they may be somebody we just want to flag. But yeah, these weekend endings, delinquents always worried me as to, boy, they're really cutting it close on their payments. So I think that's an easy takeaway for 2025 as well, is just understanding that borrower dynamic behavior, and maybe just that call and saying, hey, Seth, what's going on with your mortgage, right? Do you need a home equity line? Is there something we could do to ease your cash flows or something? Because as we know, there's a lot of consumer debt out there.
Yeah, and borrower behavior is one of the key things that call centers and collections and customer service are really able to dive into that data and really analyze what's going on and what's the borrower behavior, what's the patterns that we're seeing, what's going on, whether it's geographical or just whatever the case is. They're able to really dive into a lot of different areas with that data, and it could be very, very useful. Another thing that I think of, Seth, is taxes and insurance, because that those are increasing exponentially right now. And in talking through how clients handle their cash needs on annual escrow shortages, how do you think they can better understand and utilize their servicing data to know how much and be able to make those projections on how much and when they're going to need to cover those shortages?
Well, I think it gets back to one of the earlier points, right? There's there's reports that are being provided to these clients from the subservicer that says, hey, we're doing these escrow analysis. We're going to do 500 in October, 500 in November, and 500 in December. And if the person looking at that doesn't understand the financial ramifications around cash, they'll be like, great, glad you're doing it. But somebody
Right.
should be taking that data and actually going, wait a minute, our shortage can be Y and dollars, and do we have that much cash sitting around at this point? Maybe we need to sell more loans or something to generate the cash. So I think that's one where I think the subservicers, our friends at the subservicers, like, we communicate to the clients, but we're not sure they get what we're telling them. I think is part of the problem with that one.
Absolutely. And I think that's the same thing with delinquencies too, because when delinquencies tick up, you have all those advances, corporate advances and things like that that you need to also consider, right? So you've got your escrow shortages, you've got delinquency advances. There's a lot of different projections that you can run when you have all the data and you know what you're looking at. I think it definitely will help from a financial standpoint, you know, and driving those decisions for year end especially.
For your end especially, yeah. I'm going to
Yeah.
pivot you along a little bit. So everyone's favorite topic is the CFPB. And as I was joking with one of the agencies in DC today, a lot of our clients have actually volunteered to go to DC and help pack up Chopra's office. I'm not sure they're going to pack it up nicely, but we've got a lot of clients out there that are certainly ready for him to not be part of their lives anymore. And by all accounts, he will not be based on the election, which was one of the outcomes that we had talked about on previous Trend Series calls. But can you talk real briefly before we pivot to I guess, our next poll question to Tyler on the benchmarking around sort of CFPB actions and what you're seeing and like, how do you sort of prevent this from happening to you?
Yeah. So these are three cases that are interesting. Of course, they're allegations. A lot of times, you know, they'll agree to these and they still say, hey, you know, this didn't really happen. We didn't really see it the way the CFPB saw it. So, you know, in keeping that in mind, we see in here alleged credit reporting errors, marketing issues, churning loans, compliance issues around foreclosure actions. Those are some of the highlights here. And as you get that data from your subservicer, these are some of the things that you can focus on, especially when we talked about consumer complaints and looking at trending there. If there's a lot of credit reporting issues, there's going to be consumer complaints around that, right? You're going to have seen a trend. If that is really happening, you should be able to see that trend long before the CFPB comes in there and says, hey, this has been going on for years and years, right? So paying attention to those consumer or customer complaints is really key, and looking at those trending issues. And then, you know, how we talked about recapture, churning loans, marketing issues, that again, that's something you got to have your eye on. And then the compliance metrics that we talked about. If your subservicer has built-in compliance checks and you're able to get that data and they're scrubbing their entire portfolio every day of all of these like foreclosure compliance checks that they have built into the system, if they have that kind of a setup and you're able to see that data, you'll be able to identify, hey, there's some compliance issues here. Again, it lets you know long before the CFPB is going to come in, and then you can have those conversations. It's going to drive your conversations with your subservicer, right? You're going to ask about it. You're going to say, hey, I'm seeing some compliance issues. These are your compliance checks and you are failing them. You know, let's have a conversation about that. So it can really help guide those conversations.
No, that's great insight. And by no means, as Mignon pointed out, with these CFPB fines that are actually levied, these are negotiations, and there may or may not be any admittance of guilt, and there may actually be no guilt, right? There could just be an absolute difference of opinion between the CFPB and these mortgage entities and or banks. And so, again, by no means do we mean to like smear anyone's name here. That's why we tried to black all this out so that you couldn't see the names. But, you know, at the end of the day, anyone at any time can be allegedly charged with the CFPB for something they perceive that's happening, whether or not it's actually happening. A lot of times it's the CFPB perception. So great job, Mignon. And I know you'll be back for Q&A, but we're going to pivot here. And I think, Tyler, as we move to your section, because I really did a lot of time prepping for this, I think you actually start with a poll question before you get through your benchmarking data, if I'm correct. So Tyler, I'm going to turn it over to you. Mignon, we'll come back to you for Q&A, but Tyler, take it away. I think you've got a poll question, and then we'll move to your benchmarking data.
Next poll question. Here we
Oh,
go.
Tyler, you're on mute.
Can you hear me now?
Yep.
Okay, there we go. Well, as we approach 2025, we want to know, where does your financial and operational benchmarking rank on your company's list of strategic initiatives? So we got 4 options here. We got a high priority, moderate priority, low priority, or maybe you're unsure. So we'll give some time for everyone to put a response in here. And I'll just talk a little bit about what I see, because I'm kind of the benchmarking guru here at the firm. Commonly we hear from clients that, we're always interested in benchmarking, but it ends up being just more of a discussion of what initiatives are kind of screaming for my attention today, and can I get to benchmarking, which I think everyone wants to do. So I'll be eager to hear where this ranks on most of our attendees' priority list.
And remember, you got to answer all 4 of these to get your CPE credits. So I'll tap dance a little bit more. But as you can tell, these poll questions were crafted by these panelists, so it gave them a nice introduction into their slides. So they're crafty like that in how they're doing them. I usually ask questions like, is the sky blue, yes or no? But they're asking real questions here to try to help them craft their conversations for you all today. So Gabby, how are we doing with the responses?
There might still be a few people out there looking to get CPE who haven't put in their votes. So I'm going to give you 10 more seconds, and then we're going to close the poll. So please make sure, if you want to get that CPE, that you answer this poll question.
All right, and then Tyler, once we get the results, you're ready to launch, and I'll get to your first slide, but I know you can respond to the poll questions. And quite frankly, if you're answering unsure or unlikely or low priority, you need to be talking to Tyler. Even if you're doing it regularly, you need to be talking with Tyler here on the team to make sure you get good data.
Yeah, and so it looks like those results are in, and pretty interestingly here, we got high priority was the highest at 40%, moderate priority at 36%, and actually 0 people or 0 respondents said low priority. That actually surprises me a little bit, but that's great. And then we had about a quarter of the respondents say they were unsure. Yeah, like you said, this is a priority of mine in our group. We definitely want to put benchmarking in the hands of our clients. So if you want to have a discussion, give me a call. On that poll question, I should have just put a link to my direct line if you put high priority. But anyways, we'll jump into the numbers here, to some benchmarking. Speaking of the CFPB and recent cases, we have seen some other cases too related to redlining with IMBs, and that's been more of a hot topic. And a lot of the stats referenced in those cases comes directly from the HMDA data. So we know that the HMDA data is kind of a fair lending data set that can be used for fair lending analysis and looking at that aspect of credit across different markets in the US. But I think HMDA data also has a lot of opportunity for additional analysis for different areas, not just from a fair lending perspective. So what we're looking at here, this is looking at origination costs. I know sometimes it's called an underwriting fee or a processing fee, depending upon the state that particular loan is, but this is really origination fees, no points. But we're looking at the top 20 lenders in Los Angeles County, California. We're limiting this to only purchased conventional loans and loan sizes of 300 to 400K. And again, this is the top 20 lenders with the most volume in that loan bucket in this particular geography, and we're looking at their average origination fee. So what in conversation with clients, a lot of times what I hear from them is that they feel like they're in very tight markets. If they increase their fees at all, I think that they'd expect to lose some business. At least that's what their sales teams are telling them, that if they do that, and they're probably even telling them that we need to lower some fees here to make sure that we're not losing that business. But when you look at the details here, we do see that the average is about 1,500, and that's pretty consistent with what we see across the country. But in the top 20 lenders, even if we throw out some of the outliers here where we're seeing like 0 fees, or we see one lender there that's over $4,000 per loan, even if we throw those guys out, what we end up seeing is that the range in this top 20 is about $1,000 to $2,000 per loan. So I think this surprises a lot of lenders. when they see the, who their direct competitors, what they're charging, and have some more insight there. And this can be a very helpful tool, as you're talking with sales and you're hearing some of this pushback about, we think our fees are too high. We can dig right into these specific markets and take a look at what our peers are doing, and there tends to be quite a range. And I didn't just cherry pick Los Angeles County. I did pick that one. That's one of the larger counties in the U.S., but we do see this across most of the counties that we can dive into. So this is one example of some analysis that we can do. It's not the only one. I listed out several of the other things that we could look at with the HMDA data. There's really just so much there. Sometimes, like Mignon said earlier, it's just so much data that sometimes it's overwhelming. And so if you have some interest in doing some of these, but you want some help, definitely give me a call. We'd love to help you set up some of these analyses and start bringing this data into your decision-making process. So with that, maybe let's move on to the next slide. And so I want to shift gears a little bit here and talk about some results from our financial benchmarking program, which you may select. I'm sure many of you on the call are aware or familiar with that program, but as a refresher, that program collects quarterly financial and operational data. We have about 70 IMBs who participate here, and we go through a pretty extensive process to map the data to a very apples-to-apples format, so that whenever we're looking at something, we know we're measuring it similarly from one company across the next. So here's a highlight of the key trends that we saw really from Q3. So first of all, net production income, which is really isolating the origination platform profitability. For the most part, that's excluding servicing activity. That was a positive 10 basis points in Q3. It's the second quarter in a row that we've been positive, which is great because the prior 8 have been negative. So I think that's a big deal. I think that's a positive sign that we're seeing this year. GAAP net income, we were basically break even at a minus 0.3 basis points. That came down 30 basis points quarter over quarter. But the big driver there is really going to be MSR portfolio values. Since we saw about an 8 basis point decrease on average from this peer group, that translated to 30 basis points on origination volume, just how these clients are leveraged with servicing. Cost to originate, $11,600 per loan. So, this is also a positive, quarter over quarter, we're down $200 per loan. Looking at last year, this same time, we're almost down about $1,000 per loan. And this is the lowest cost to originate that we've seen since 2022. So again, that's more positive. The big driver in the most recent decrease in costs was just really seeing more funded units, about a 3% increase quarter over quarter. And then lastly, we'll touch on secondary gain on sale before we move to the next chart here. But secondary margins were down about 4 basis points, not a lot of movement. But you take this change in gain on sale, combine it with a 4% increase in volume, and then you get flat net production income. So not too much there. Things holding steady. So if we go to the next slide, right here, we're going to break out net production income from Q3. And so this is looking at each lender in our retail peer group, what their net production income number was for the quarter. So we see the average at about 11 basis points, but there's quite a range here in terms of what lenders experienced. 65% of these lenders had at least $1 of net production income during the quarter. That's up about 3% from last quarter. We were at about 62%. So again, we're seeing improved performance in Q3, which is great, but definitely we're still seeing some quarters some lenders who had a loss last quarter. And so it's great to see Q3 and Q2 have positive net production incomes. I mean, we're used to an industry where we're supposed to have our strong quarters in Q3 and Q2, but I'm interested to see where we're tracking on a year-to-date basis. So if we take the next slide over, this is that net production income again on a year-to-date basis. So it's a little bit of a different story. The average is actually a minus 7 basis points year-to-date. But if you actually look at the distribution of lenders, still the majority of lenders had a positive net income. So 57% of lenders still had that positive net production income, but clearly there's a few lenders who had a much tougher Q1 that's going to drive that year-to-date number a little bit more negative and drive the overall average negative. But for that 57% of lenders, I think that's great news. I think that that 57% of lenders is going to have a good shot at being net production income positive for the full year. On a GAAP basis, I think we'll see a larger percent have a positive GAAP net income, just because of how servicing has been helpful. Of course, that assumes that we're not going to see a big servicing write down at the end of the year, but I think there's a good shot there. So excited about those results. So moving gears, I wanted to spend a little bit of time talking about cost to originate. Like I said, $11,600 per loan was what we hit for Q3, lowest since 2022. Still 11.6 is it still hits me a little bit hard because pre-COVID we were in the $8,000 to $10,000 range. In Q2 and Q3 we're seeing costs at about $8,000 per loan, and then in the winter quarters we're back to that 10,000. So it's a little bit different for me. It's still like I said, it still gives me a little bit of sticker shock, but I think we're actually we're seeing some of the dust settle a little bit. I think we are kind of getting closer to what I think is going to be the new norm. And give me a second here, and I'll try to elaborate on this slide on why I think that's the case. So this slide, we're not looking at that total 11,600. We're really just looking at the fixed cost component of that cost to originate. And this is going to be costs, that fixed cost component quarterly from Q3 of 2024 all the way back to 2017. And so in those blue bars, which is that cost, we can really see that those fixed costs, they're only 6% higher in 2024 than where they were back in 17 and 18. And it's not a cost standpoint. I think at this point, we've cut a lot of costs. It's really a units issue because units are 30% less. So if you do the simple math, if we're trying to get back to that cost structure from 2017 and 2018, we need 50% more units to get there. And so that's really where the challenge is in the industry. This year, we're on pace for 5.1 million units, but 50% or a 50% increase on that means we really need 7.6 million units. And so if you excluding 2020 and 2021 in the last 10 years, 7.6 million units, we've only seen that 2 times, and those years were years where we had significant refinance activity that boosted that, and so that's why I think we're kind of to a new norm here. I don't know that we're going to see that kind of volume. In fact, I don't think the MBA's forecast has 7.6 million units as you go further into the future, and so we're going to just have to adjust a little bit with some of the new costs here. So that's where we are from a cost standpoint. I did want to take a little bit of time and also talk about production trends as we look into Q4. So this is a newer benchmarking solution that we have. It's real-time ops and sales benchmarking. So we update this daily, and it gives us pretty good insight to what we're seeing from an application and a lock standpoint among our client base. So we did get some rate help this year. Of course, it only lasted for 10 weeks, and now we're back in the high 6s today. But those 10 weeks are going to help us, finish the year strong in terms of volume. In this chart, you can see that both application and lock volume were at its highest in September and October for the year. So that's great news, and a lot of that, a lot of those locks in October are going to fund in Q4, and that's why I think that there's a pretty good shot that net production income could be positive for Q4, and for that, for that portion of lenders who are positive now, there's a good shot that they could be positive for the full year of 2024, which is a nice milestone to see happen amongst still a very challenging environment. Of course, we've snapped back to seasonal norms, as you can see with the sharp decline at the right end of that chart, and we're all feeling that now, but we are kind of where we are, and this is where we kind of expected to be, with rates where they are.
It certainly, Tyler, looks like we're going over the cliff here in November. So, and with a late Thanksgiving, that's not going to be good, and a short window to Christmas. We'll see how that affects the overall volumes. The calendar's a little bit goofy this year compared to last year with the timing of those holidays. From the standpoint of kind of feedback from MBA Annual, I think one of the common conversations that you and I were both in there was that a lot of shops, regardless of the production forecast, really weren't going to be bringing on any more fixed costs, right? They were going to go with the same amount of personnel in 2025 as 2024. And if they got a spike in volume, they were going to use overtime as opposed to the yo-yo hiring game. I think that was a common theme across the vast majority of my meetings with lenders that, they've cut their staff to where they can't cut anymore. And that staff is actually going to have to be able to be a little bit more fungible if there is a pickup in volume. I mean, were your conversations kind of consistent at MBA annual on that topic?
Yeah, no, and I think that the staff will be really happy for that approach. I mean, I think that they feel the same effects of the yo-yo of like, hey, we're staffing up, and then all of a sudden, there's less volume there than we maybe anticipated. So I think they'll be happy to work overtime, and they'll be happy to move into that versus putting people on furlough or wondering about where the pipeline's going. So I think that'll be a positive for everyone, and that does seem like the right approach, especially as the MBA is changing their outlook a little bit, getting a little bit more pessimistic in 2025.
Yeah, we'll cover that kind of at the end, maybe on the interest rate trends, but that's great information as always. So good news, profitability for most people during the quarter. Yes, servicing took it on the chin in Q3. As you pointed out, right now, if rates stay where they're at, they'll get a nice write-up in Q4 on servicing because rates have come back vastly from where they were as of September 30th. They're almost back to June levels of rates. So, and production is at zero. So all in all, pretty good. Maybe the fourth quarter will be pretty good, and we'll see how that first quarter pays out. Great job, Tyler, with all that production data and with all the benchmarking data. And you can see, having some of this real-time data here, where you can kind of see the trend for November is telling. And having listened to a bunch of earnings calls, this is exactly what the equity analysts ask all the publicly traded companies as to, well, where are you compared to last quarter? And this would, not that we've got a lot of publicly traded companies on this call, but just knowing this is very good for management and the team. All right, with that, we're going to pivot to IT controls. And obviously, as Tyler has pointed out, hey, we've actually made money the last 2 quarters. I think one of my major concerns across the industry is that as we weren't making money, certain areas of the company might have gotten less, as Mignon probably knows. Maybe we scaled back slightly on the number of internal audits. That one's critical. That one's not so critical, so I'm not going to do that this year. But certainly IT process and controls and data is a critical element. October was cybersecurity month. I know it's a big thing when they talk about it on sports talk radio and I hear all the cyber commercials. I know that it's a real thing. I just thought it was, I thought we had made it up here at Richie May, but no, it is cybersecurity month. And so if you missed all our communications on that, shame on you, but Patrick works on that. And so Patrick, with that, I think you start with a poll question as well. And then you've got some IT process controls and data to talk through with our clients to try to set them up for success in 25. So with that, Pat, I'll turn it over to you. And I think you got a poll question.
Yeah, thanks, Seth. So SOC reports are a hot topic these days. So the poll question here is, what does SOC stand for?
S-O-C-K, SOC, the thing I'm wearing on my shoes, inside my shoes. Oh, this is SOC. I got it. Well, I get this one wrong. Good thing I'm not going for CPE credits. Are we grading these CPE questions at this point? Remember, you got to answer all 4 of them to get your credit for this. And Gabby, how are we doing with responses?
We have a few more responses to get in, so get your responses in. We'll close this out in about 10 seconds.
All right. I got my answer, but I'm sure it's wrong. So I'm going to fix my answer so I get my CPE credits.
All right, we're going to close this out.
All right, Pat, how'd they do? They passing?
We had some funny ones in the class today. But yeah, the results came in strong. What I like to see.
All right. Well, can you tell them the right answer?
SOC, Service and Organization Controls Report. Well, thanks, Seth. So like Seth said, everyone's favorite topic, and the reason I'm sure you're all here today is to learn a little bit more about IT security and compliance. So from a security perspective, mortgage companies, they're entrusted with, your client's most sensitive data, social security numbers, account numbers, income, credit history, the list goes on and on. So as a result of this, just becomes increasingly important to make sure you're taking proper measures to protect and safeguard this data. So a good place to start, what a lot of our clients do is conducting an annual internal audit over your IT general controls, usually over your critical systems such as your LOS or other systems that house a lot of PII. So what is an IT general control audit? Step one would be to look at your logical security controls. So this is asking the question, you have this sensitive data, do appropriate personnel in your company have access to this data, right? And we love it as auditors when our clients implement the idea of least privileged access. So employees in your company only have access to data necessary for them to perform their job function, and that's about it. So you want to keep that as secure as possible. Okay, so logical security is good. People have the correct access. Step two is looking at change management controls. So that's ensuring that, okay, it's all right that they have access to this data, but they're not able to go in and make, unauthorized or unapproved changes. You take proper safeguards there to protect that data. Okay, so logical access and change management, those controls all look good. What happens in the event of a global pandemic or a natural disaster? So thinking about disaster recovery, incident response controls, those become extremely important as well, because we never really know what's going to happen. So, if you have data centers housed around the country, making sure that those aren't separate locations in the case of a natural disaster, stuff of that sort. So having that backup plan in the event of a disaster is critical. Any questions, Seth, on IT control environments before we hop into SOC?
No, I think going to the next slide and actually explaining what SOC 1 versus SOC 2, it's not left and right in my shoe. I think it's important for folks.
No, that is not it. So SOC 1, just want to keep a high level. SOC 1 is really relevant for your internal controls over financial reporting that could have an impact on, your customers, counterparties. SOC 2, think security, IT. That's really the main difference there, Seth. What we're seeing mostly is a need for the SOC 2 reports. So SOC 2 audits will assess your company's internal controls over 5 different areas as defined by the AICPA. It's called the Trust Services Criteria. So your internal controls over security, availability, processing integrity, confidentiality, and privacy. So this audit really helps confirm that your internal controls over data handling and security practices meet industry standards, give your stakeholders a lot of confidence when you're able to issue a SOC 2 report. Hey, we take your data protection seriously. We spend time implementing and monitoring these controls on an ongoing basis.
So Pat, how long does it take to get a SOC 1 or a SOC 2 done? And do I have to do both? Or can I just do a SOC 2? Do I SOC 1? Walk us a little bit further down the path here on these, just so that people are kind of aware as they go into 2025 what they might need or what they might be needing to ask of their vendors. Because this is something also you have to ask of your vendors, I'm imagining, where you're sharing data.
Yes, exactly. Great question. So from a timing perspective, a SOC 1, so there's 2 types to make it even more confusing. There's a SOC 1 type 1, a SOC 1 type 2, a SOC 2 type 1, and a SOC 2 type 2. The type 1 is just a test of the design of your internal controls. So it's just looking at the controls at a specific point in time. Hey, is this control in place? Was it designed effectively? Start to finish, you could probably complete one of those in 3 to 6 months is do a type 1. A type 2, looking at the same controls, but the auditor would be testing those over a period of time. Typically for what we see most commonly is a 9-month reporting period. So if you were to go straight into type 2, you're looking at probably a 12 to 16-month process to get that all wrapped up.
And this is something, if you're using outside vendors, that is there an expectation that mortgage vendors, mortgage tech firms, most of them have this in place? And
it is. It's becoming increasingly important to have in place, and we're seeing it a lot of times as almost a pay to play in certain areas, saying, hey, if you want to work, we love what you're doing. You have this great application, but if we're going to give you access to all of our data, what are you doing to protect it? So them being able to say, hey, we got the SOC 2 report, we got our security controls in place, your data is safe with us. It gives stakeholders and and your counterparty just a lot more confidence that you're taking it seriously.
Yeah, so it sounds like it's table stakes. So again, if you're
Yeah.
not getting this or you have questions on vendors or whatnot, this is something that Pat and his team can help with. And Mignon, you participate, I know, on some of these internal audits as well. And the prioritization of internal audit work that you've done this year, is this like moving towards the top, or always been at the top and stays at the top? Or has it migrated all of the last couple of years from what you've seen clients asking for from the internal audit outsourcing we do?
Yeah, that's a great question. It has become more of a priority. I feel like 2-3 years ago, clients were pushing that IT off on the schedule, like, oh, we'll kick it down the road a year or two more. And now there have been so many breaches in the industry and just other industries too. It's just it's a real hot topic. It's a concern for a lot of organizations, and it is becoming more of a priority. And we see that clients are not pushing it down the road any longer. They are ready to do it. And, so we're having those conversations and making sure that we're having Pat's team work with those clients to get that done. And it's something among the subservicers that I talk to as well. They're very concerned with data privacy and security. And, like Pat talked about the business continuity and disaster recovery. That's huge right now. A few years ago, we were all able to say, well, we had a real life test, through the pandemic and we passed, right? Okay, we can't use that excuse anymore. It's been a few years. It's time to go back to, you've got to make sure you're doing your table talk exercises and doing, all of the things that you're supposed to be doing, your vulnerability scans all the time, and internal and external penetration tests, and testing the network, applications. A lot of subservicers are coming up with their own mobile applications for borrowers to make their payments on and things like that. These are all technology that we love and that we're communicating with, but they have those security concerns, and so they need to be looking at those. They need to be checking and testing those periodically for sure.
No, that's great feedback. It's good to know that it's consistent, that it's kind of an important topic and probably will maintain an important topic. I guess I'm in charge of the key takeaways, so it's a good thing I was paying attention today about what we've got going on. Look, if you're using subservicing, kind of my key takeaways, regardless of what's on the screen, if you're using a subservicer, or even if you're servicing in-house, make sure that the information is getting to the right area. Make sure it's not being blocked by somebody like the CFO doesn't understand compliance and compliance doesn't understand about recapture. Make sure you've got a good process in place. There's a wealth of information that subservicers are providing you. Use it to your advantage. And also, as we talked about towards the end, understanding the financial risks that occur with delinquencies and or escrow analysis and where you may have some cash shortfalls. So there's a lot on that side of the house to button up for 2025. When it comes to the financial side, as Tyler pointed out, right? There's a wide range of expectations out there on fixed costs and, HMDA data, misinterpreting HMDA data, manipulating HMDA data. But in addition to that, the industry is off the lows, right? We are profitable again, which makes us feel better, which actually gives us more money to spend on IT process audits or on SOC processes internally or externally, depending on if you're a vendor or where that process is. The data, it is going to be, we're going to see increasing legislation, whether it's California, Colorado, or New York, around processes with data. So make sure you understand that. Make sure you get your compliance team involved as well on all those topics, because it is critically important to make sure that you are protecting these borrowers' data. And importantly, to loop it back into something Tyler and Mignon talked about, and recapture is a critical element, right? These are your customers. So what are you doing trying to keep them, life of loan customers, life of their life customers, as opposed to just this one and done transaction? We've got one more poll question that we need to ask, and I can ask this one since I have it written down. Remember, we got to answer all four. And we do have a couple questions coming in, but I was gonna try to wrap up real quick with just some election highlights. But the last poll question, remember, got to answer all four of these. This is the last one. Will you be attending MBA's AFM conference in December? And will you be heading over to Mignon's for dessert after the Richie May event because Neil lives out there. She doesn't know that she's posting something afterwards, but it's always good to surprise people at their house. But the answer, yes, no, or still deciding on whether or not you're attending. And remember, that's December, I think, 11th through 13th out in a lovely Phoenix. So for those that are in cold weather climates, Mignon promises it's going to be beautiful out there and not snowing, which is maybe advantageous for folks. So I don't know. I can't see the polling results, but how did we do, Gabby?
Results are in. This was a much easier question than all the others. It looks like about 60% aren't going and about 30% will see you there, and there's still a few deciding. So
all right. Well,
the
last couple of minutes, I do have one follow-up question for Mignon on subservicing and if you're seeing people switch subservicing. But I wanted to really just kind of wrap up from the last trend series when we talked about the election and the preview election. What happened? Republicans won the White House, the Senate, and the House. What does that mean? Well, to be determined. But what's likely to occur under the Trump administration will be the extension of the tax cuts, obviously new directors at key agencies in DC, including the CFPB, FHFA, and HUD. And that will ultimately lead to a new Ginnie Mae president. So there'll be a lot of change there. Hopefully in each one of those positions, we get somebody who's very familiar with mortgage and the mortgage process. That would help everyone out on the call. Interest rates have gone up after the Fed actually has started cutting rates. And as Tyler and I have chatted about a couple of times, the expectation is rates may stay here in the 6% range for longer. So that's going to impact everyone's profitability. And one thing to just keep on your radar, it's very likely that the Trump administration will be trying to get Fannie and Freddie on a path out of conservatorship over the next 4 years. It doesn't mean they necessarily are going to exit conservatorship, but they're going to put them on a accelerated path to get them out from conservatorship because they're coming up on, I don't know, 18 years in conservatorship, and now that they can drive a car, we should let them out of conservatorship. I don't know. But anyway, Mignon, real quick question for you. You deal a lot with subservicers, you deal a lot across our client base. Are you seeing a lot of companies change subservicers at this point, or is that still kind of a little bit muted due to sometimes the transfer costs? That was one of the questions that came in.
Yeah, actually for the past year or two, we have seen a lot of clients change subservicers, sometimes due to cost, sometimes due to customer service issues that they're seeing, as they're looking at the data like that we just talked about, right? And looking at their consumer complaints and the trending there and seeing customer service issues with their subservicer. They're saying, hey, I'm going to go out there and look around and see what else is out there. And we have seen a few change subservicers for that regard. And then also just pricing. There are a few subservicers out there that are a little cheaper than others. Most of it's pretty close, but there are a couple of them out there that have a little different pricing model that are being looked at a little bit more just as a way to save money. The initial transfer sometimes is costly, right? And it takes a lot of resources to make that change happen and everything, but long-term could be beneficial for the organization if they're able to go to a cheaper model. So, but a lot of different variables and things to consider when you're changing subservicer. So price is not the most important probably, but customer service and those consumer complaints are going to be a big factor.
Price and data sounds like the important ones. It's probably data first, and how are you going to really help those borrowers long term. I'd like to thank all our panelists. I'd like to thank everyone who participated in the call. Wishing everyone, thank you again for being a Richie May client. We really do appreciate the partnership. We look forward to serving you in the future with a variety of our services that we kind of outlined today in a very soft way. But as you can tell, there's a lot of experts here at Richie May that can help in a variety of ways to reduce risk, better use data, better understand financials, better understand IT controls, keep those risks down so that profitability returns. Last thing we need is a lot of hiccups. As Tyler's pointed out, thin margins. So, if you reduce risk, that is a way to improve profitability over the long term. But we wish everyone a very happy Thanksgiving. We will catch up with you all in 2025 with Q4 results. Tyler's already predicted that's going to be a great quarter, or at least to be a positive quarter, not great. And we will be, don't forget the survey. and we will look forward to chatting with you 25. The survey will be up now. We really do appreciate your feedback. Happy Thanksgiving to everybody. Happy holidays, and we'll be back at you in 2025. Thanks everybody again, and thank my panelists for a wonderful job. You did great, and we'll talk to y'all soon.
Thanks, everyone.